Hey guys, I'm just going to do a quick lesson on how, because this is going to be part of our research practice, and it has to be done on every single share we're going to qualify. Because what it does is it tells you whether this company is making good money, whether it's got ongoing growth for two, and whether it's going to get a good return on our net investment. So this tells you whether the operations of the company is really good or whether it's pretty poor. So, and this is particularly very important if you have got a PE ratio which is really high. Like normally a bargain PE ratio is something between 15 and 10 and 20. Very seldom you see that at the moment. Right at the moment we've got Apple is really low, about 11, and so that's a good buying ratio at the moment. If you have a look at all the other qualifiers to make sure that that's worth it. Anyway, so we'll stick to the game plan here. So this has got a really high PE ratio, and as you can see here, if I go to the chart, so you just go to finance.yahoo.com. It's got all sorts of cool tools here. So what the key here is, you want to see whether you're paying full price or reduced price. So this is the last 5 years. I took the 5 year box. It gives me a 5 year history, and you can see the highest peak here was back in on the 24th of the 9th, which is down the bottom of the line where I've got the little thing here, right down the bottom there. You'll see that there. That's the date there. So 24th of the 9th, 2018, it was 154.92 per share, which is on the right hand side of the dotted line over here. And then currently in the green, it's got 153.43. So as you can see, we're paying $1 less, which is which is basically, it's come down and it's on its way back up to where to almost exceed where it was 5 months ago, which is quite normal. Sometimes you see that recovery in less than a month. But anyway, the important thing, this is really important, guys, so just pay attention, rewind and replay, whatever you need to do to get it to stick. So once you get into the habit of doing this, it's going to take 5 minutes, and you want to do 4 years. So it's going to be quite cumbersome to, I've got a little set of equations here, which I'll show you guys how to do one day. But anyway, so what you got to do, first of all, is go to Financials tab. Because what we've got to do is work out the net return on this business for us as an investor. It's our business, we're putting money into it. What are we getting out of that? What is it? Is our money working for us, or is it just a waft-tam and we're just relying on the market to take the price up? You don't want to do that. You don't want to do that because the market's so volatile. You want to make sure that it's supported by very strong financial and good business running operations. I can't say that with enough conviction. There's going to be the odd time we bend that rule, and we'll discuss that when we get to that at some stage. So in the financials little sub tab here, go to the balance sheet first. We'll go back to the income later. So there's 3 tabs here. There's income, cash flow, balance sheet. Go to the balance sheet. We want to know all the current total assets. So this is 2017, 16, 15, 14. We want so total current assets. Go all the way to the bottom here. It's got this here, plus it's got other things in here like property, plant, etc. Total assets right here. So this is what we want. 797,164. We write that down. Current liabilities, we roll down to go to total liabilities, 551,581. So I've done that. I've actually written that down for these 4 years for both liabilities and income. What I haven't done is I haven't actually calculated the difference. So you subtract the assets, which was the 797,164 minus the 551,581, gives you 245,583. Okay, so that's a positive number, which is really good. It means that they have basically, they're not trading insolvent, so the assets are worth more than their liabilities, which is fantastic. So now we go to the income statement, and what we want to do is we want to figure out what the actual net income after all expenses, taxes, everything is gone, what's left. So basically, the quickest way to do that is just roll you've got everything here go pretty much roll to the bottom of the screen, and it tells you straight away net income. Here, you want to be careful here, because preferred stocks and other adjustments is basically management giving their senior executives stock as cost, and that comes off the bottom line. So you've got to take that into account as well. So what we've got here is we've got 50,000. Oh, is it in thousands? Oh, it's 50 million. So these guys, man, these guys are amazing. They actually cracked. Was it these guys? No, sorry, no, wrong story. No, anyway. So as you can see, if you have a look, we'll go back up right up to the top here. Go to the revenue. Look at the revenue increase since 2014. We've got 44 million. We've got 113 million, 202 million, and 308 million. So you can see that that's going up very well every year on year. So they're getting quite popular. So that's something to first of all look for, but let's get back to the basics. So we've got this number here, 50798. So we had our number over here, which was a 254. So now we need to go to put those two numbers into a percentage calculator, which I've got a little link here. Okay, and we want to go to this percentage difference calculator. So we go for the 245, which was the net difference from the assets minus the liabilities, 583, tab into the next field, and then Matt will know that I like using my tab rather than anything mucking around having to get off the keyboard. So do a calculation here, and that comes out at 79. So basically you go back to your 79.31, go back to your calculator and clear it, and go 100 minus 79 point, what was it, 131. So that gives you 20.69% return. That's a pretty good return. That's a really good return on investment. That's, I mean, 20%. That's huge. That's huge. Even the top money managers like struggle to get 18%. But so you've got to do that for every year though. Okay, so I just need to do the same thing for. So this is how quick. Once you've got your data written down, you can pretty much go. Total assets 537. This is in 2016. 596 minus 373,216 equals, so write that down, 164,380. That's your net results after your assets and liabilities have been removed. I'm going to do this for all the remaining 3 years to just show you how quickly it is. 231 minus 164,958 equals, that's 45,273. And then the remaining one, just clear it with escape. 102,238 minus 79406. That leaves 22,832. So now you go back to you clear that, go back to your percentage difference calculator, and we'll just clear these out. And put in your second year, which was 2016, because we just did the 2017 one. So we've got 164,380 tab, and then we've got minus 26 here, 727. This is going to be interesting. Okay, so that's going to be a dud. That's pretty much obviously a zero return out of that year. That's a negative return out of that year, so that's not good. So we'll go back to the previous year, which was 45,273, and the remainder was of income was 8,764, and that's come out at so you go back, so that's 80.64, so you go 100 minus 80.64 is 19.36%, and clear. And the year before that, we'll go back into here again, we had 22,832 832 net income assets, and we've got 8764 income remaining, and that's 61.61. So you go 100 minus 61.61, so that's a 38.39% return. So 2017 we had 21.69% return on investment, which was really bloody good. The year before we had a loss, which may have been something to do with they would have been expanding the business or something. You'd have to look further into that to find out, well, hang on a minute, that's not. But consistently before that, we've got like 2000, so that's 17 was 21.69%, 16 was a net loss, 15 was 19.36%, and 2015 was 38.39%. So what you can do is you can go 21.69 plus 19.36 plus 38.39, 19.36, 21.69 equals, so that's 57%, so divide that by 4 because we had a 0, so that's 14, so average return is 14.42% net return. That's really good, and that's not even considering the price increase, which we've had a massive price increase. So you go to the charts, and over 5 years the stock has risen from $28 to $153. So let's try that out in the calculator. 153, 28. Oh, other way around. It's 446% increase in value, which is pretty huge. So these ones here, you could possibly, I mean, they've got good financial stability. These particular ones, you could put in. I would suggest we could put this into something like our high risk. It's not that high a risk because they're quite strong financially, and yeah, anyway. So that's how you do it. So any questions, just get hold of me and we'll talk about it. Cheers. Talk to you later.